Hello, fellow Rebel Capitalists. Hope you're well. So we've got interest rates exploding higher. What does that mean for the stock market, gold, Bitcoin, treasuries, etc., and maybe even the global economy? We're going to dive into that in just a moment. And then Meta, Facebook, Zuckerberg, backpedaling significantly on the whole woke nonsense agenda and censorship. That's great news. But they actually hired someone that is going to totally blow you away. Unless you've seen this in the news, you've got to stay tuned because they hired someone that you would not expect if I gave you about 10 years to try to pick someone. You would not come up with this individual. And guys in the chat, if you've heard about it, don't give it away, for heaven's sakes. Don't give away who Meta, or Beta, as I like to call them, just hired. They brought them onto their board. But anyway, more on that in just a moment. And then we're going to talk about the real dollar crash and what central banks around the world are going to be doing about it. So let's dive straight into the first story here, and that's with interest rates. My goodness gracious. The 10-year treasury getting up to almost 4.7. And you got to ask yourself, what is that doing to mortgage rates? What is that doing to housing prices? Well, let's say downward pressure on housing prices moving into 2025. And that doesn't mean prices are going to go down. It just means downward pressure. Again, there's a lot of different variables we have to consider. But let's shoot over to a chart of the 10-year treasury yield. And you guys can see exactly what I'm talking about here. I mean, right when the Fed started cutting rates, the 10-year treasury yield was down around 3.6, call it 3.65. And we have gone not straight up. Nothing goes up in a straight line. But now we're up to almost 4.7. I mean, this is a move of 100 basis points. And for all of those people on Twitter and all those people in the mainstream media and all of the experts out there that for some reason, it baffles me to this day, but for some reason, their entire worldview, as far as the dollar, interest rates, it all revolves around the Fed. So it's just this belief, your starting point is always the Fed controls interest rates. I'm talking about these experts. I just often wonder if they just ever look at history or ever just look at a chart. It's just one of those things that's said so many times that people just believe it without even looking into it. Because they're like, well, if this wasn't true, then people wouldn't say it over and over and over again. So I don't even need to go into some charts to see if there's any correlation there. But then what baffles me even further is those people see this playing out in real time. And then they see that often there's an inverse correlation. And yet they never, ever, ever just sit back and maybe second guess this theory that the Fed is at the center of the monetary solar system, or that the Fed is at the center of interest rates. Well, let me just show you what I'm talking about here. So the Fed has dropped the Fed funds rate by 100 basis points. 100 basis points since September 18th of last year, 2024, right? So they've dropped 100 basis points at the front end of the curve, but yet the 10-year treasury has gone up by 100 basis points. a 2% spread. So you tell me, how can you come to the conclusion the Fed controls or even influences? I mean, they've got some influence, granted. I mean, if interest rates right now were at 0%, I'm talking about Fed funds, then would the 10-year treasury be trading lower? Probably. But it depends, really. It depends on why they dropped to 0%. Right? I mean, I could give you a scenario where that might even drive rates higher at the long end as far as the 10-year, because growth and inflation expectations would increase. And I can also give you a scenario where if they dropped, then the 10-year treasury would definitely be a lot lower because they're dropping in response to economic data weakening. You see? So at the end of the day, the long end of the curve especially, it's really there's obviously thousands of variables, but the main driving factor is going to be growth and inflation expectations. It's not going to be what the Fed is doing. And a lot of times I get pushback there. Well, George, okay, I know they control the front end of the curve. Do they? Do they really control it? Or do they just follow the 2-year treasury? Because if you look at a long-term chart here, I mean, it's almost in lockstep, Fed funds with the 2-year treasury. 2-year treasury goes first. Gunlock points this out all the time. 2-year treasury goes first, and then the Fed just follows. So are they really controlling interest rates, or are they just following where the market is taking interest rates? Those are two completely different things. And then I always get the pushback of quantitative easing. They say, oh, George, well, okay, so the Fed's following the 2-year, but if they're doing quantitative easing, then they're buying all of those treasuries and keeping long-term interest rates a lot lower than they otherwise would be. Again, this just, to me, it's like, have you ever looked at a chart? I mean, I know that makes sense as to why that would play out that way, but in real life, have you ever just tried to poke holes in that and ask yourself, what have interest rates actually done when the Fed has done QE? Because you just assume that interest rates are lower, but have you ever actually researched that? That's what I'd like to ask these experts, because if you do, let's just Google it here real quick. Let's see. Let's do 10-year versus QE. Let's see if we can pull it up there. And actually, let's go to the images, see if we can pull up a chart. It's this one chart that I always reference a lot of my videos. QE. Let's do this. I'll get one more try, then we'll get back on topic here. So QE 10-year rates chart. Let's do that. Aha, here we go. So let's zoom in on this bad boy. And you can see, I mean, this is just, it's not even like this is my opinion. It's really not debatable. It's just, here's what happened. It is what it is, right? It's not like I'm spinning it or, this is just my view. No, look, they started doing QE1 during this green shaded area. And at the time, the 10-year treasury was about 2%. And by the time they got done with QE1, the 10-year treasury was trading at 4%. It went up by 200 basis points. While the Fed was doing QE, in other words, while the Fed was trying to bring interest rates down at the long end of the curve. And that all of this additional artificial demand from the Fed did what to interest rates? Made it go up, not down, because the market overpowered the Fed, as you would expect. And because the Fed was doing QE, what happened? Growth and inflation expectations, they went up. So even though the Fed was buying it long into the curve, which would lead you to believe that interest rates would come down because of the inverse correlation between rates and the price, we saw the exact opposite. So what the Fed was trying to do, what their intentions was to bring down interest rates, and interest rates actually went up. So you tell me how the Fed is controlling interest rates, or even, look, if you want to argue they're just influencing interest rates during QE1, I would agree with that. But they're not influencing rates down. They were influencing rates up. So any way you look at it, the people that think the Fed was in control or actually influencing rates, they were wrong. Because even the people that say, okay, they don't control them, they just influence them, their position is that they influence rates to where they were lower than they otherwise would be. And we can see that there's a better argument for the opposite, that interest rates are higher than they otherwise would be. Look at QE2. Start off with a 10-year, and look at this. Every time they stop doing QE, what happens to rates? Then they plummet. Once they stop QE, or look at this. When they do, oh, I thought that was Operation Twist. I thought this was QT. And then look at here, we start QE2, 10-year, I call it 2.5. We get done up at 3%. So an increase of 50 basis points. Then QE3, the 10-year is starting at, call it 1.9. And then we end up at 3% at the end of QE3. So there's just, I just think the argument for the Fed controlling rates or even influencing them in the direction they want them to go is a very, very poor argument. So anyway, now let's get back to the chart of the 10-year Treasury yield, which isn't going up, obviously, because of the Fed, because they're dropping rates. It's going up because growth and inflation expectations are increasing. Now, what we have to do is we have to ask ourselves, the growth of the economy that's built into the interest rate, now it's being baked into the cake, is this going to come to fruition? What are the probabilities this comes to fruition? Because let's be clear, if interest rates are going up because of growth and inflation expectations and the growth materializes, then the economy should be able to withstand those interest rates. No problem. In other words, if the rates on the 10-year, let's say, go up to 5%, and then we see the growth come to fruition, then the market should be able to handle not only those 5% interest rates, but they should be able to handle 7.5% on the 30-year mortgage. You see, this is another different way of looking at things, which I think is far more accurate. It's not that, oh my gosh, higher interest rates are going to crash the economy, or oh my gosh, low interest rates are going to stimulate the economy. Not really. Not really. Because the interest rates themselves are a reflection of what is expected in the economy. The interest rates aren't really producing a result of the economy. They're just giving you basically a price signal of what the expectations are for economic growth and inflation. Where most people see it, again, from that Fed-centric standpoint, whereas, oh my gosh, if the Fed is increasing rates, then that's somehow going to crash the economy. Well, I don't know. It depends. If the Fed is raising rates and the long end's going up at a faster level, then I don't know that's really going to crash the economy, because what this is telling us is that the economy can withstand the higher interest rates. But if the Fed's raising while the 10-year's pegged or actually going down, you get the inversion, then the market is telling us, whoa, time out. The Fed has interest rates too high at the front based on what the market's expectation for the economy is over the next few years. Okay, so then you got to ask yourself, is this increase in interest rates sustainable due to the underlying fundamentals? Because if it's not, then what's going to happen is the higher interest rates are going to potentially be a catalyst for the economic slowdown, or they're going to exacerbate the slowdown we otherwise would have had. So now, and just to keep things in context here, we're right back to where we were in April. Now, you say, oh my gosh, interest rates have exploded higher. Yes, they have, but let's just keep things in perspective. And what I mean by that is, let's shoot over to the 10-year 3-month. Because a lot of people would say, okay, since the long end is going up, the Fed is losing control. And what this is telling us has nothing to do with growth, George. It has more so to do with inflation. And that's inflation expectations are returning. Okay. Let me just show you this chart. And if I just showed you this chart alone, what conclusion would you draw? We've got the 10-year versus the 3-month. So we see where we are today, where the curve is steepened out to the point where now the 10-year Treasury is higher than the 3-month. Okay, but what has happened in past cycles when the curve steepens out and is no longer inverted with the with the 10-year and the 3-month? You see, that's not a good sign. Now, will it play out completely different this time? Maybe. Absolutely. It could. But it might play out the same as most of the cycles that preceded this most recent inversion. Again, we're just looking at a game of probabilities, right? And then what you can do to add a little more accuracy to your analysis would be, are we seeing this steepening of the curve as a result of a bull or bear steepener? Because right now we're getting a bear steepener, which is great. That's what you would expect if the economy is doing better. We got to see how long that lasts, though, because we see these fluctuations, let's say, throughout different cycles. In fact, over the past few videos, I've gone over what happened in 2008 when interest rates on the 10-year went up during that cycle by, you guessed it, 100 basis points. So this is nothing new that we're experiencing right now. We just have to watch it very, very closely. Now, let's just assume for a moment, going into 2025, the Fed keeps rates where they are right now because inflation's sticky, the economy is showing signs of improving, unemployment rate goes down, something like that. In addition, let's assume the 10-year Treasury goes right back up to its normal spread. So Fed funds right now, 4.25%. So that would mean, let's just look at an average here, just kind of eyeball it. We can see the average is about, let's call it 1.5%. So we're at 4.25 on Fed funds. So if the 10-year Treasury gets back into the range of, call it 5.75%, which would keep us right in line with this 150 basis point average spread. So if the Fed funds goes to 5.75, or 10-year goes to 5.75, now all of a sudden, George Gammon is going to be saying this time it's different. This time is absolutely different. And, I'm no longer that bearish on the economy. But if we see the 10-year start to stall out and, go back down to 4.6, 4.5 as the Fed continues to drop rates, and then if we see the 10-year drop even faster, so we go back into that bull steepener scenario, then we're right back in line with what we have seen in past cycles. So honestly, I don't know which direction this is going to go. Obviously, I'm going to be watching this like a hawk and giving you guys my opinion and my take on it as we see these significant changes. It's all about measuring probabilities, but my point is, I think this along with the dollar is probably the most important two things that you can be watching right now. And we're going to get into the dollar later on in this video. Let's look at mortgage rates, because I know one thing that we all have in common is we have to put a roof over our head. And a lot of you are renters, but I know a lot of you are homeowners. A lot of you are considering buying a house. A lot of you are considering selling your house. So we look at mortgage rates, and obviously the 10-year Treasury has a lot to do with this. We see that right now, national average has just crept over 7%. And I wish I could get a longer term view, which I can. So we were higher than this in October 2023. We're right around 7.89. But we have gone up pretty significantly since the Fed dropped rates. Again, you tell me the Fed controls rates because they want to stimulate. Let's just back up for a moment. Why did the Fed drop rates? According to Jerome Powell, because he said that they were much more focused now on the unemployment rate versus the inflation rate or the CPI. So they have their dual mandate, but what they wanted to do is put more emphasis on the unemployment rate because we saw the Somme rule triggered, etc., meaning that they wanted to keep the unemployment rate down. They didn't want it to spike higher like we had seen in past recessions. So in order to do that, they wanted to drop interest rates. Well, they're not just saying we want to drop interest rates at the front of the curve, because how much does that really impact the real economy? I mean, a little bit, but what impacts the economy even more so is the 10-year Treasury yield. So what they're telling you is that we want to drop the front end of the curve because we want the long end of the curve to come down to support the economy so we don't have that spike in the unemployment rate. Again, what has happened? The complete opposite. The complete opposite. Where let's think about it this way. Let's assume the Fed never dropped rates in 2024. Where do you think the 10-year Treasury would be? I think there's a good argument that it would be lower and that mortgage rates would be lower. So you tell me how the Fed influences the long end. If anything, they have the opposite influence of what their intention actually is. But anyway, now let's look at this through the lens of what housing prices are doing. I think I had this pulled up. Long-term trends. Let's go over there. Now, the fact that housing prices are at an all-time high, that in and of itself really doesn't scare me too much. Sure, you can say that housing prices are expensive relative to their historic norm, and that's a very crucial data point. But we also have to add the price to income ratio. This, to me, is even more important, because when I really see a red flag is where the prices not just go up in nominal terms, not just go up a lot faster than the rate of inflation, which mean that real prices are getting extended, but also when nominal prices are going up way faster than nominal wages. This, to me, is the biggest red flag, because you got to think about housing prices just really being an extension or a derivative of two things. It's going to be interest rates and it's going to be incomes at the end of the day, right? Assuming that the supply side can gradually keep up with demand, which it should, because if prices are a lot higher than incomes, then demand is going to come down, right? Especially if interest rates on the 30-year fixed rate mortgage are going up as well. So you can see the delta we had during the GFC or prior to the GFC, where the Case-Shiller Home Price Index was 331 and incomes were at where were they here? Income's a lot lower. I don't know how I should we look at the delta between the increase? Let's do that, because the increase from 1996, and the reason I like to use 1996 is because the prices we had back then adjusted for inflation were pretty much identical going all the way back to 1900, even the late 1800s. So that's always kind of my starting point as to where prices should be based on kind of normal interest rates and incomes. So then you can see this huge discrepancy where the home prices went up by 120%, but incomes only went up by 50%. So home prices went up by an additional 70%. This was just prior to the housing bubble bursting. And there's no one that would argue we were not in a housing bubble back then. So now let's look at the delta. Back then, again, it was 70%. So we fast forward to today, and our delta is about 100%, because prices have gone up by 282% above, I would call their historic norm, going back to late 90s. But the incomes have only gone up by 190%. This is nominal terms, of course. But the point is that spread is higher today than it even was in 2006, meaning that homes are even more unaffordable. So that means to me that demand is likely to come down. Now, if supply goes down even faster than demand, we could see home prices continue to appreciate. What are the probabilities of this? I don't know. I, I would say relatively low, especially if we go into a recession. Now, the other thing that you could see is you could see incomes skyrocket and get to the point where they're a lot closer to home prices, and then you could see a reacceleration of prices. But again, what are the probabilities that the US economy just booms to a point where nominal incomes would increase a lot faster than home prices? I don't know. I mean, it's definitely on the bingo card, but that's not my base case for obvious reasons. So this is how, when you look at the 10-year treasury yield and you look at different asset classes, obviously how it's pertaining to the housing market, which my point here is it's already very fragile based on what I think is the most important metric, and that's the price to income ratio. All right, but let's get back to this chart of the 10-year treasury yield because it is impacting other asset classes, such as stocks. Stocks are down on this news. NASDAQ is down almost 2%. And then we saw the Bitcoin just get shellacked today. Went up over 100,000, which was great. Got up to 102, but now it's down under 97,000. And I think that short-term pop was just a result of news that, whenever something comes out in the news about this strategic Bitcoin reserve, I think that Michael Saylor went to Mar-a-Lago. And I think that's probably what drove up the price. And usually that's kind of buy the rumor, sell the fact. Then you look at gold, interestingly, up. So I have not yet looked at the dollar, but I would assume that it is up on the news, which it is. Not at the level we saw the other day, over 109, but on the day, it is up. Call it, looks like maybe 40 basis points, something like that. So you've got interest rates way up. You've got dollar up, gold up. And another, I think, fallacy that I always hear from experts is that gold is like the inverse of the dollar. I don't know where you get that. like for the past, even since the cerveza sickness, I mean, they've gone up almost in lockstep. They've definitely gone up. I'm talking about the dollar relative to other fiat currencies and gold. So I don't really see that as kind of a rule. It's a lot like the oil being the inverse of the dollar. Remember when I first got into this in 2012? That was like the narrative. That was like one of those rules that was set in stone, that if the dollar is going down or if oil is going up, then the dollar is going down on the DXY. And I always thought that was kind of like, I don't really understand the mechanical causal effect there. And sure enough, as we've seen lately, there's been almost a zero correlation. And definitely not an inverse correlation between gold and the dollar. So this tells me that it's got a component of flight to safety in there if gold and the DXY is up at the same time. Now, I think what would really be the tipping point is if we saw 10-year treasury yield going down, gold going up, dollar going up. That's where I think you get a lot closer to potentially the stuff hitting the fan. Let's go back to the CNBC homepage. So we've got, we talked about that. Oil up, which isn't as interesting because I think there's supply side kind of rumors there. I think that's a buy the rumor, sell the fact as well. But as you can see, overall, this is kind of a trend toward the market baking into the cake, maybe higher growth and inflation expectations. Now, is that going to come to fruition? We shall see. We have seen these types of moves within a larger move throughout cycles, notably the GFC and the dot-com bust. For me, it all goes back to the steepening of the curve, how it steepens out, and if we get to that point where the 10 years trading, let's just say 100 basis points or 150 basis points above Fed funds. Remember, right now, the curve is almost flat. The 10-year treasuries trade about 50 basis points higher than, maybe a little less, than the Fed funds rate. So historically, that's still pretty flat. And all is being equal, if you just dropped out of the sky from Mars and I said, look, this curve is pretty flat, you'd say, oh, that isn't inflationary. That is actually disinflationary. That metric alone. So again, we're going to have to watch this like a hawk. Let's get over into the second story of the day that I wanted to address. And this is what's going on with beta, or meta, as they call it, and Mark Zuckerberg, the ultimate beta. Although I got it, he's probably been watching Rich Cooper's videos. Josh, what do you think? You think Mark Zuckerberg is all of a sudden becoming red pill aware? He's been watching Rolo.
I mean, he's getting pretty damn close. He's doing some awesome things.
He's almost at the level right now where I don't know if I can put him in the beta category anymore. I mean, he's been doing jiu-jitsu, he's going to the UFC, he's now becoming anti-woke. I don't know. We'll have to see where he is here in a year or two. Maybe he's going to be right up there with Rolo and Joe Rogan. I don't know if I can ever put him in the alpha category, but I'll keep an open mind, let's say. So what on earth is going on with Zuckerberg and Meta, or Facebook? This comes out in the news today. Meta scraps fact-checking, brings back political content, and latest Trump-friendly move. So key talking points. Meta announced it will eliminate third-party fact-checking, and it will implement community notes, a model similar to what Elon Musk is doing with Twitter. Zuckerberg said the company is also bringing back political content on its platform and removing restrictions on subjects like immigration and gender. And Meta announced the changes on Fox News. Wow, okay. So this, in and of itself, well, actually, let me read some quotes from Zuckerberg before I get into my editorial. We've reached a point, now there's a quote from Zuckerberg, we've reached a point where it's just too many mistakes and too much censorship. Now, I'm not saying Facebook is going to become a model of free speech. I'm not saying they're going to be the world's #1 champion of free speech, freedom, and liberty. No. Don't get me wrong. But I am saying that even if this is just a PR move on their part, it's still a step in the right direction. Because let's assume that they don't restrict or they continue their censorship move behind the scenes. The fact that this is changing the narrative within the mainstream media and also setting an example for other corporations that they can follow suit, I think it's really important. And whether you like Elon Musk or hate him, I mean, I go back and forth. There's things that he does that I really dislike, and there's things that he does that I really do that I really do like. And a lot of times I'm very suspicious of his motives. But the bottom line is, regardless of your opinion of Elon Musk, he has absolutely paved the way for other Silicon Valley CEOs to stand up against this woke nonsense. He's almost like the kid that called out the emperor for not wearing any clothes. That once the kid did it, then everyone's like, okay, I guess this is okay to do now. So I can stand up to the insanity that I have seen all along. I don't think Zuckerberg just woke up one day and said, you know what, I've been wrong this whole time. I think he was kind of playing the game that he thought he had to play, knowing that this woke stuff was to a certain degree nonsense. And now all of a sudden, I think it's just okay for him to say the quiet part out loud. I'll say that I'll just give him the benefit of the doubt. Now, you may say that he has ulterior motives, and I think there's a great argument for that. But for the time being, I'm going to try to give him the benefit of the doubt. Let's see if we've got any. Here we go. Zuckerberg also said that the third-party fact checkers became too politically biased, and we know in which direction, and have destroyed more trust than they have created, especially in the U.S. Well, I think he's spot on there. I mean, if you look at net balance, these fact checkers, they've just obviously a huge negative as far as public trust on balance. Zuckerberg also said, we're going to work with Trump to push back on governments around the world that are going after American companies and pushing to more censorship. Man, talk about a 180. It's really phenomenal, isn't it? To go back just 6 months and see where we were as far as this censorship, misinformation, disinformation. Remember that? That wasn't that long ago. And all of these social media platforms were on board. And all of a sudden, 6 months later, they're all doing a complete 180. Again, I don't know what their motives are, but regardless of their motives, I think that this is a positive and a step in the right direction. I don't know how you could argue this is a negative. Another thing he points out, directly responding to threats that you may have made in the past, or what? No, okay, let's skip that. Honestly, I think they've come a long way. Okay, now this is Trump talking. Excuse me. Okay, I thought that was Zuckerberg. So he said, honestly, they've come a long way. Meta, Facebook, I think they've come a long way. Trump always repeats himself like that. You know, what's also fascinating is a lot of these CEOs are coming out kind of doing a 180 from the woke push, and they haven't gotten a lot of pushback. Now, obviously, they're not going to get a pushback from the Rebel Capitalist Pro community and people who are for free speech and for freedom, liberty, and against 1984 Orwell. But for the other side of the crowd, you haven't really seen that just massive hysteria that we saw around this type of, well, I was going to say that this, I think you haven't seen that massive hysteria around a lack of censorship like you would have seen 6 months ago. You know, I think if he would have come out and said this or done something like this, you would have all of these protests. I mean, you would have had, you probably would have had a lot of politicians going after him. I'm talking about Zuckerberg. You probably would have had just open up this huge can of worms. You would have had AOC really, tweeting about it, saying that this is ridiculous, that they're all far right, and he's been taken over by Nazis and blah, 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 right? But you really haven't seen too much of any of that. Weird, isn't it? Now let's go over to what I think is fantastic. And it makes me lean on the side of this being a genuine push for Facebook and more specifically Zuckerberg. Let me show you what I'm talking about. There you go. Remember when I told you I could let you sit there and make guesses for the next year? And you would not have guessed Facebook just hired this guy? Dana White, president, I believe CEO of the UFC. Facebook just brought him on their board of directors. That's it. For me, this is much more representative of their true intentions, other than them just coming out with a PR statement saying, oh yeah, we're going to cut back on the censorship and we're going to cut back on the woke nonsense. because, those are just words. What I'm looking for are actions. And this is an action. And, Dana White is one of those guys that he doesn't give two F's. And for him to come onto the board, I don't think he would do that just because Zuckerberg said, "Oh, please do it. You're going to help me out, Dana. And we're still going to be super woke. But if you come onto the board, then we can fool people into thinking that we're more pro-freedom and pro-liberty and pro-free speech." And then Dana's like, "Yeah, okay, I'll just go ahead and I'll join in on your ruse, Mark." To me, Dana's not that type of guy. I don't think you could pay him enough money to do that. Seems like a very principled dude. And so I think this means a lot more as far as the future direction of Facebook in terms of censorship than them just coming out and saying that they're getting rid of the third-party fact checkers. So how many of you guys had this on your bingo card? Let me look in the chat here. I know this really surprised me. I was like, Dana White? Okay. Wow, that came out of right field, but it's a pleasant surprise. I'm really excited about that. We'll have to see where it goes. Now, for a moment, let's also look at the overall landscape in corporate America, because I saw multiple stories today about not just Facebook, but companies. We're looking at Zero Hedge right here. Companies like McDonald's, who, according to Zero Hedge, I'll just read the title, another DEI domino falls. McDonald's, the latest to bail on diversity goals. And so we see this really spread throughout corporate America, where they're trying to distance themselves on pretty much everything that they were pushing just 6 months ago. And even Target and Walmart came and said that they were going to cut back on all the whole rainbow and gay apparel and all this stuff, especially for kids, that they're going to distance themselves from that. You see McDonald's, you see a lot of other companies saying, you know what, we're going to kind of just get rid of all of our DEI objectives we had before. It's almost like all of these corporations were just trying to pander to the existing political administration. And once that changes, now they're like, okay, we don't have to fake it anymore. Or maybe they have no principles whatsoever. And each one of these big corporations is just trying to suck up to whoever is in charge. That's definitely a possibility. Like they don't care about DEI and they don't care about getting rid of DEI. Like they have no principles whatsoever. They don't care about free speech and they don't care about censorship. It's just they're going to care about censorship if the political administration cares about censorship or is pro-censorship. And then if the current administration is pro-free speech, well, then now all of a sudden they're pro-free speech. So that could be, putting on my more cynical hat, that could be what we're seeing right here. But then kind of looking at this through some rose-colored glasses, or maybe the glass half full, maybe they were just going along with all the woke nonsense, which they thought was nonsense, just because they felt they had to. Now they can come out and call a spade a spade. Again, we'll have to see how this plays out. I'll definitely want to see how this plays out, after Trump is no longer there, and assuming you get a Democrat, then I really want to see what Zuckerberg does, but we'll have to wait a few years for that. So let's check this out. The news came in an open letter to McDonald's, its owner, operator, employees, suppliers, among other factors influencing the move away from DEI. Okay, great. So this was a bottoms-up type of thing where all of the McDonald's franchisees were like, look, this is hurting business. This is stupid. Nobody wants to do this. We want to hire based on meritocracy. We thought that's what everyone was colorblind, right? So let's just go back to that. And it looks like that was a letter, an open letter to McDonald's from owner-operators. That's what I'm gathering here from this story. They pointed out the Supreme Court's 2023 ruling that struck down race-centric admissions practice. Okay, Here is where I want to give a huge shout out to my good buddy Robert Barnes. I don't for those of you who are big fans of the channel, you might have seen the interview I did with Barnes on this topic, on the Supreme Court ruling. This was, I forgot. I mean, it would have been right around the same time. And I can't remember what the title of the video was. I apologize. But I remember specifically talking to Barnes about this because he said that Supreme Court ruling was a big deal. Remember, that was the one regarding Harvard and Yale and whether or not that they could prioritize, let's say, black students, even though that they might not be as they might not have the same skill set or the same qualifications as, let's say, an Asian. So they would have to, even though they weren't as qualified, they would have to go with that black student. That was kind of the DEI move. And the Supreme Court came in and said, no, you can't do that. You're literally judging people on the color of their skin. you can't do that anymore. And what Barnes said is this ruling would have ripple effects throughout the entire economy, because now all of a sudden, if this is the rule against Harvard, well, then corporations are going to be less likely to push this because they don't want to get in the crosshairs of the Supreme Court. And so it looks like the owner operators that wrote this open letter referenced their Supreme Court decision, and this gave them quite a bit of leverage. And this is exactly how Barnes said it would play out. Quote here, we assessed the shifting legal landscape to anticipate how this ruling may impact corporations such as McDonald's. I guess here is a statement from McDonald's. But prior, look at this. Zero Hedge outlines a lot of the corporations that have pulled back on this DEI woke nonsense. Walmart, Ford, John Deere, Lowe's, Harley Davidson, Jack Daniels, Microsoft, United, Boeing. I mean, this is fantastic. This, to me, is great news. So, looks like some talking points they gave, McDonald's. We are retiring setting aspirational representation goals, meaning judging people on the color of their skin. We are pausing or hiring people just based on the color of their skin. We are pausing external surveys. We are retiring supply chain's multi-commitment to DEI pledge. Yay. It's great to see this in the United States, where maybe, just maybe, we still live in a society that's sane enough to where the pendulum, if the pendulum swings way too far to one side, we can get it back to the middle. Oh, that's funny. There's a meme. I think you guys can probably see this, of all of the companies that have got kind of, let's see, woken up to how you go woke and you go broke. No pun intended. Okay, you know what? I want to do a quick shout out here or a quick promo, quick plug for Rebel Capitalist Live, because we were just talking about Barnes, and Barnes is going to be a speaker at Rebel Capitalist Live. And if you haven't seen Barnes speak publicly, or if you haven't had the chance to sit down and talk to him face to face, have a beer with him, which you can do at Rebel Capitalist Live, you've got to make that a high priority. That's for sure. Now, what I want to talk about next is how these central banks are viewing the United States dollar. And the real crash in the dollar, to me, isn't the dollar versus other currencies. It's really what it forces other economies to do, and what it forces the central planners to do outside of the US, and how the dollar going up can lead to a crash in other things, such as their local domestic economies. Now, one more plug for Rebel Capitalist Live. We're going to be talking about this a lot with this guy right here, Joseph Wang. You guys know him as Fed guy, and he used to work at the New York Fed. He used to work on their trading desk. So it's going to be great to have him at Rebel Capital Live, getting his insights as to what these central banks are doing as a result of the dollar going up, and if they have any power to bring the dollar back down. And if they don't, how does that impact their economies? And could that lead to the real crash, which, again, isn't necessarily the dollar, but it's in their domestic economies? I mean, let's go over to this story right now. And we're going to talk about Vietnam. And we're going to use this as a proxy for other central banks. And I want to go into what the Japanese central bank is doing about how the yen has fallen to, I don't know if it's an all-time low, but it's close to it. So here we go. Vietnam closely watching FX market after Dong. It's kind of funny. That's like a Beavis and Butthead, right? He said dong. That takes me back to my Beavis and Butthead days. You guys know what I'm talking about. All right. Their currency fell to a record low. Central bank vows to keep inflation and currency stable. Dong has greatly strengthened. Gradually strengthened at the start of the year, but now more recently has fallen back to a record low. Check this out. Vietnam's central bank said it's keeping a close eye on the local currency, which fell to a record low last week versus the dollar. So let's think about this. This is one of the huge advantages the United States has. They really don't need to include FX in their monetary policy, right? So again, I don't know that the Fed has that much of an impact, as we discussed in the first video. But let's assume they do, to whatever degree it is. They don't really have to think about, oh my gosh, what is the dollar doing relative to the euro, or what is the dollar doing relative to the yen, or what is the dollar doing relative to the dong, let's say. Because most things are priced in dollars, global reserve currency, that's a huge advantage to the United States, because all the debt here in the US on the balance sheets of the private sector and the public sector, for that matter, is going to be denominated in, you guys guessed it, the United States dollar. And all of our commodities that we have to import are going to be denominated in the US dollar. And most of our imports are going to be denominated in the US dollar. Again, a huge advantage. Where if you are the Vietnamese central bank, you're screwed. Because if the dollar is going up to 109, or if your currency is at an all-time low, well, then what does that mean for the dollars that you have to buy to get those commodities you need? And what does that mean for all of those private entities within your economy that have dollar-denominated debt? Effectively, what's happening is prices are skyrocketing in local currency terms, right, for the stuff that you have to import. And your mortgage payment, let's say, your debt payment, is going up and up and up in terms of your local currency, which your revenues are denominated in. You see, it's very hard for people to understand why having dollar-denominated debt is such a big deal for these foreign entities, let's say in Vietnam, because it's just like you having an adjustable rate mortgage. And let's say your mortgage payment is $2,000 if your adjustable rate mortgage is 3%. And you can afford that. But what you can't afford is if your adjustable rate goes from 3% up to 12%, because that's going to take your monthly payment from, let's say, $2,000 up to $3,000. Well, now all of a sudden you can't afford that extra $1,000. So you're screwed. What are you going to do? Well, you're either going to sell your house, you're going to default, or you're going to have to sell something else in your balance sheet in order to make that mortgage payment. Well, if you're a Vietnam corporation, what are you going to sell? You're likely going to sell something that's denominated in the Vietnamese currency, which exacerbates the problem, because that makes the dollar, all else being equal, go higher against that local currency, meaning your adjustable rate mortgage went from 3 to 12. Now it went from 12 to 15. So you got to sell even more of your local currency to buy the dollars you need because you just don't have that cash flow. And you definitely don't have the dollar cash flow. You see? So, and it's not just the Vietnamese central bank. Let's go back here, and I'm just on Bloomberg, and I just went to economics and then typed in and then did the subcategory of central banks. And right here, Japan warns on speculative FX moves after yen hits 6-month lows. Now, you guys know as well as I do, whenever the central planners come out and blame something on speculators, you know that it's never, ever, 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 ever a result of speculators. It's a result of the underlying fundamentals. And then the speculators just come in because they notice an opportunity. But it always starts with the underlying fundamentals, right? Then they just always blame it on the speculators. And another thing that you can almost guarantee is whenever they blame a price move on speculators, usually, even after they intervene, the price move or the trend continues. So this is why when I was in St. Bart's, as an example, it was the first time that or maybe not the first time, but it was about 6 months ago. Remember when the Japanese central bank came in and said that they were going to defend the yen? I think it got to 160, something like that. And they came in with all of these, selling their dollar FX reserves or whatever it was to try to support the currency. And when I was in St. Bart's with Steve at the time, I said, well, what do you think of this? He goes, dude, I've seen this countless times before. I'm like, okay, how does it usually play out? He's like, no, how does it always play out? I'm like, okay, how does it always play out? And he says the way it does is the currency just goes to where it's going to go, regardless of what the central planners do. And I say, okay, what does that mean for the yen? He says it's going to 200. Going to 200. He said it might not go there in the straight line, but it's going to 200. And they can kick the can down the road a little bit with these interventions, but eventually the market is going to take over. So let's assume that it does go to 200. Think about what that does to the dollar-denominated debt on these corporate balance sheets in Japan. And then what does that do to how much these commodities that are priced in dollars cost that they have to import in terms of yen? The costs go up and up and up and up, and their debt payments go up and up and up and up and up, which has what effect? Which could lead to their economies crashing. So whenever you see or you hear about someone talking about the dollar crashing, I don't know that there's a high probability the dollar crashes relative to other fiat currencies. I think there's a much higher probability that other currencies and therefore other economies crash as a result of the dollar going up. I've said for the last 2 or 3 years, if you look at the mechanics, it's pretty clear that the risk to the dollar is on the upside. It isn't necessarily the downside when you're looking at it relative to other currencies, which is extremely, extremely important, even if your sole focus is Bitcoin, gold, silver, U.S. stocks, U.S. housing. Why? Because if the dollar goes up to a certain point, you're going to hit a threshold where liquidity freezes. And if liquidity freezes, that's going to be very negative for all assets, including anything in the United States. Let's go back and see. We've got let's see what's happening in Chile. Bank publishes minutes from December's quarter point rate cut. Policymakers see inflation easing to their 3% target. Of course they do. They always see the market coming to wherever they're trying to lead it, although that never, ever, ever, ever happens. So the board members agreed with the outlook showing the key rate declining, or the forecast rising policy wrote minutes when they lowered borrowing costs to 5%. Okay, the agreement trajectory. What I want to see is the dollar relative to the Chilean peso, because if that is plummeting, then a lot of what they're saying is probably due to FX and they're just trying to spin, or they're just trying to use this as a diversionary tactic. So before we even go further with this central bank story and the dollar potentially crashing their local economy, let's go to Chilean, I spelled that wrong, peso to USD. So it's 1,000. Actually, let's do 1 year. It's always difficult to. Okay, so this is going down. So I think that means. Let's do this. There we go. Yeah. Okay. So obviously, and this, my goodness, this is just the last month. Ooh, boy. Okay. Yep. This is confirming my suspicions. So in the last year, we've gone from 900 pesos to the dollar all the way up to over 1,000. So a 10% decline in the value of the Chilean peso versus the dollar. So again, that's like your mortgage rate going up substantially, because a lot of their debt in Chile, maybe not the government debt, but the corporate debt, the private balance sheet, is going to be denominated in dollars. And look at what it's done just in the last month. I mean, just in the last month, it's gone from 950, 957, straight up to over 1,000. That's a big move. So let me go to the Mac. Oh yeah, look at this. This chart goes all the way back to December of 2003. And we are almost at an all-time low for the Chilean peso versus the dollar. Said another way, we're almost at an all-time high for the dollar against the Chilean peso. And by the way, for those of you who think the dollar always loses purchasing power, it's just it loses purchasing power a lot less than other fiat currencies. I would challenge you. Look at what the dollar has done relative to the Chilean peso since 2018. It's gone from 600 called up to 1,000. That is a massive appreciation as far as the dollar. And now what I'd want you to do is calculate how much the dollar has appreciated against the peso, and then go ahead and calculate what the local inflation rate has been compounded during that time frame. So over the last 6 years. And I can almost assure you that the local inflation rate has not been as high as the appreciation of the dollar relative to their local currency. So what does that mean? Why is that important? Because what that tells you is that the dollar is actually increasing in purchasing power relative, not just to their currency, but to local goods and services. So the dollar is gaining value against stuff that you would buy in Chile. That's a big deal, isn't it? Because it isn't true that the dollar is going down just slower than all other currencies. It all depends where you are. If you're in the United States, that's absolutely true. Of course it is. But if you're in many other countries in the world, that's not true. The dollar has actually appreciated in value. Why does that matter? Because it just makes the dollar network that much stronger. And it just makes the dollar as the reserve currency that much more attractive to foreigners, whether we like it or not. Now, there's some things that make it less attractive, like Biden doing all these crazy freezing of the accounts and all of the, what were they called? The measures against all the Russian oligarchs and, locking them out of the SWIFT system and all the sanctions and all these things. Yes, that's definitely negative for the dollar as the reserve currency, but you have to reconcile this with all of the positives. And the fact that the dollar usually maintains its purchasing power in local currencies or in local domestic economies like Chile outside of the United States, you got to add that in there is a positive for the dollar retaining the title of the global reserve currency. But more importantly, what we need to do is focus on the FX rate to determine how that's impacting these international economies, the economies outside of the United States, because that's where we could get into a liquidity event, because the dollar is quite literally going up to the point where it's forcing a collapse of these other economies, and therefore their central banks having to step in and intervene, but usually the market is going to take it to where it otherwise would have been. And then how does that ripple back and affect the US economy in a global economy that is so interconnected? These are the questions, in my view, that we need to be trying to answer. All right, guys, on that bombshell, enjoy the rest of your afternoon. As always, make sure that you are standing up for. Hey, guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow rebel capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.